Amazing what a rising market will do. Oh, it's going to get a lot higher. In fact, I told people 5 weeks ago, this is a great time to buy. I got criticized for that. Now they don't criticize me anymore. People should have listened. But it's going to go a lot higher.
I think in retrospect, perhaps holding cash would have been the best way to navigate this, but that's so contrary to our culture of always trying to be on the offense, always trying to find ways to create value in the markets.
With markets rallying, should investors have listened to President Trump or one of his biggest backers, billionaire Ken Griffin? Live from Singapore, this is Insight with Haslinda Amin, a show where we will dive deeper into the market moves with crucial context and sharp analysis. Chip stocks are back in focus as President Trump's Middle East visit opens a floodgate of AI deals led by NVIDIA, pushing the chipmaker back above the $3 trillion valuation mark. Meanwhile, investors in China are awaiting earnings from the biggest names, including Tencent and Alibaba, to gauge whether the recent rally has legs. Plus, we are counting down to the 90-day truce between China and the U.S., under which both countries will roll back their tariff hikes. We have a big interview coming up with S4 Capital founder Martin Sorrell, who has been a vocal critic of the uncertainty unleashed by Trump's tariff flip-flops. He tells us why there is no going back to normal when it comes to global trade. Well, we kick off with the markets. Asia stocks are extending this week's gains, fueled by the cooling in trade tensions. China is set to cut tariffs on U.S. goods in the next hour and vice versa. Bloomberg's Evel Hong is tracking all the moves for us. The question is whether the rebound is sustainable. And we heard from Trump, I told you so.
Yeah, I mean, he's been very positive about the stock markets, right? But at this point, I think it's really dependent on whether we see this follow through on the US-China trade deal. There's still a high degree of uncertainty when it comes to ultimately what the impact from tariffs is going to be for the economy, for consumers in this 90-day period and beyond. For now, though, investors seem to be focusing on the positives, the sense of resilience you get for Chinese companies in particular. Case in point, JD.com, fastest pace of revenue growth in 3 years, and it's getting that boost from the government's trade-in subsidy program. Maybe this gives it further fuel to ramp up its program on food and its quick commerce businesses to do battle, wrest market share further from the other tech names like Meituan. Now, flip the board. This week, of course, we are watching out for Tencent as well as Alibaba earnings. And Tencent today expected to show a steady pace of growth, bolstered by its broad portfolio in social media, in gaming businesses. This chart, courtesy of MLI's Mark Cranfield, shows you how it's really been outperforming the Mag 7s. And these earnings scorecards could be the next driver of the leg up for Chinese tech. That could also help it to continue outperforming the Mag 7s, even though we're seeing the short-term boost for U.S. chip stocks. Now, flip the board again. The question we keep coming back to this week, Has, is really the extent in which the Sell America theme has been reversed. And of course, we're seeing futures flat now, but overnight we did see the benchmarks erasing their losses for the year, helped by this US-China trade truce. On top of that, the sense that there's a limited impact on inflation from the tariffs. Businesses are not rushing to pass on higher costs to consumers. This is what we're seeing for now, Has.
Well, it's all about earnings as well, guiding the markets. And we have breaking news out of Sony. Sony now saying that it is forecasting operating income for the full year that misses the average analyst estimate, operating income at 1.28 trillion yen. The estimate is for 1.5 trillion yen. Also, Sony saying that it will buy back up to 250 billion yen of its own shares. Of course, that in a way shows its confidence in the outlook for the company. Again, Sony to buy back up to 250 billion yen of its shares. And in terms of its forecast, operating income for the full year, missing that guidance of the average analyst estimate at 1.28 trillion yen. The estimate was for 1.5 trillion yen. Well, let's talk markets. Joining us now is Charu, Chief Investment Strategist at Saxo. Charu, quick reaction to the numbers out of Sony and the guidance so far. It does seem like, there's pessimism despite the market movements today.
Yeah, absolutely. It does look like, export-oriented companies and export-oriented economies continue to face that pressure coming both from, these tariff headlines, but also from the currency side of things, where we've seen that massive strength in the US dollar, which obviously is reversing right now, but, it has been very, very strong for several years now. So I think that really playing in, but, to come to talk about the broader outlook that there is, I think obviously there are a lot of positive themes that are playing out in Japan, particularly, like the corporate governance reforms and how it can really attract businesses that are really looking to diversify and make their supply chains more resilient. So I think there are some very specific themes in Japan, but certainly the currency aspect is something that investors cannot ignore there.
Let's pick up on the currency, right? Because a lot of people are actually expecting the dollar to continue to weaken from here. What does it mean for the yen? What does it then mean for exporters in Japan?
I mean, certainly, I think the dollar's, gains, the valuation, and this whole U.S. exceptionalism theme being questioned, investors really trying to rotate out of America, in terms of diversifying their portfolios, looking at, Europe, looking at China's tech sector particularly, that has come to weigh down on the U.S. dollar, and potentially there's more to go there. But when you come to think of what benefits in the month of April, when we saw that risk-off theme kind of really being the headline in the markets, you did see Japanese yen and Swiss haven, for example, really being in gaining on the back of that. But now again, those themes have turned around and the markets are a little bit risk-on again, and we see the risk-on currencies, the Aussie dollar particularly, really gaining on the back of that. So I do think that there's this complete dependence on what kind of headlines we get, mostly on the tariff front. But, to me, it seems like the tone is a lot more conciliatory now instead of what we had earlier, which was more confrontational. And that does mean that, the risk environment can remain steady.
We talk about U.S. exceptionalism. Take a listen to what one of our guests had to say about it.
I think in retrospect, perhaps holding cash would have been the best way to navigate this. But that's so contrary to our culture of always trying to be on the offense, always trying to find ways to create value in the markets.
First, U.S. exceptionalism, is that theme still intact? And second, is sitting in cash the way to go?
Okay, so let's take that one by one, right? When you talk about U.S. exceptionalism, it's a very structural theme. I know tactically, I did say that the risk environment looks a little bit more positive, and that might be the case. On a structural basis, I think we have to be a little bit more, cognizant of the fact that there are a lot of themes at play, digitization, for example, clean energy, healthcare, all of this in such a flux. And with the U.S. administration also now, I think tactically shifting focus more towards tax reform, and probably deregulation as well in the weeks and months to come. If we do see these tariff headlines kind of taking a backseat, I don't see why the U.S. exceptional theme will be questioned in a big way. It will fade, of course. It has been, very heavily loaded. So there are reasons, like I said, to diversify into other regions which offer a more compelling valuation and some more strong structural factors as well. But I don't see that going away. I think the innovation, the liquidity, the kind of, the markets that we have in the US, I think they're still very, very robust, and you don't get that kind of innovation and liquidity anywhere else as of now.
So would you be holding cash when you consider all these circumstances in the next 12 months?
I don't mind holding a little bit of cash, but that's with a very different reason. I think you obviously have to keep in mind that when you hold cash, inflation is kind of eating up your cash there. So why I like holding cash, and a little bit of it is to be ready for opportunities, because we know in this volatile environment we can see a lot of long-term thematic opportunities come our way at some very favorable prices, which has not been the case in the US markets for the last many years. So I would want to keep that as a flexible tool, not as a defensive tool.
We're seeing renewed optimism in China, given the tariffs have been suspended for 90 days. Is China becoming more attractive? We had the PBOC saying that, you know, China has the fiscal capability to actually lift growth.
So China's faced two kinds of headwinds, right? One is their domestic headwinds, right? I mean, deflation, demographics, and debt dynamics there. Plus, on top of that, we've had these trade tensions as well with the new U.S. administration. And both of those have kind of been subdued in the last few weeks and days, particularly for the tariffs front. But I haven't seen any structural responses really on those fronts to kind of say that, yes, we've gone past those kind of headwinds now. So certainly, again, you know, when investors want to move out of US and want to consider different options that are available at a more attractive valuation, I think China's tech sector, particularly because of the private innovation push that we are seeing there, has, you know, looked quite compelling in that sense. But to say that, you know, a broader outlook for the China market has really turned around, especially with these tariffs just on hold. We still have about 30% tariffs on Chinese goods, and effective tariff rate from the US is still as high as 10-15%, 5 times higher than where we were at the start of this year. So that is yet to show up in fundamentals. So what has just turned is the tone and the sentiment, not the fundamentals. So I think I would be still a little bit cautious on the broader China outlook.
We're also looking at the consumption story through the earnings of the likes of Tencent and Alibaba. That may be the catalyst for a leg up for Chinese stocks. I mean, what are you anticipating? Because right now consumption remains pretty muted, and there are still big question marks about whether or not China can boost consumption domestically.
It certainly has been the case that tech sector has been driving much of the returns in the China markets last few months. You know, since DeepSeek, we've seen that momentum really pick up in the China tech space, and then we had these you know, reforms and announcements from the Chinese administration as well, where they did not just focus on consumption or housing market, but there was a huge push on really driving this tech innovation as well, which is a huge regulatory shift from where we were a few years back. So that has obviously, you know, increased the scope for these Chinese tech you know, companies to really be the competitor. We know tech, AI, particularly in this age, is the new oil, and, you know, there's a lot of focus on self-sufficiency and self-reliance, and that does mean that the China tech sector could continue to grow. But then again, the regulation is a big, you know, play there. So we have to continue to watch what comes out of the administration.
Before we let you go, it's not just about the Mag 7 or the US dollar, it's also about where oil is headed.
Yes.
And we've heard murmurings from the likes of Goldman saying that, you know, oil could be hovering between $40 and $50. Your take on where it's headed and how best to play that?
So certainly both from the demand outlook point of view and the supply outlook point of view, there is a concerns that, you know, the oil could see further pressure from here. We know that fundamentally, as we discussed, tariffs have not started to play out either in company earnings or on hard data from the US economy itself. So that if that was to play out in the coming months and quarters, we would see demand around commodities also being questioned. And what offsets that? Does China demand really offset that? I mean, you know, global demand really offset that weakness in the US demand? Potentially not so much. And on the supply side also, we've had OPEC Plus really coming out and increasing their supply. So I think there is a you know, a fear that, you know, we could see further lower oil prices from here.
And not forgetting Iran. Charu, thank you so much for that. Charu Chanana, Chief Investment Strategist there at Saxo. Still ahead this hour, we'll talk more about the uncertainty triggered by the Trump trade war with Martin Sorrell, founder and executive chairman at S4 Capital. Keep it here with us. This is Bloomberg. Welcome back to Insight. Former U.S. Ambassador to China, Nick Barnes, thinks the trade war between Washington and Beijing is nowhere close to coming to an end. Speaking to Bloomberg, Barnes says the root of the current tensions lies in China's trade policies.
Well, first of all, I start from a first principle, and that is that China's been the largest and most important disruptor in the global trade system for about 3 decades right now. There's a reason why the United States and many other countries around the world have placed tariffs on China. China's manufactured exports in particular is because China's been dumping them around the world below the cost of production. And it's been a killer for jobs, both in the United States historically in the last several decades, but also around the world. You have a situation now where Turkey and India and Brazil and Colombia and Mexico and Canada and the United States and the European Union have all put tariffs on China. So I have a degree of sympathy for the situation that President Trump and his team inherited, which was a situation that we left when I left in mid-January as ambassador to China. President Biden, a year ago, May 2024, placed 100% tariffs on Chinese EVs, 50% on semiconductors, 25% on lithium batteries. So the root of this problem is China and Chinese trade policy. The Chinese are trying to act now. You saw it in the statements over the weekend from Vice Premier He Lifeng, is that they're the innocent party, that they are the victim of this trade war by President Trump, when in fact, and that they're the responsible party, when in fact the reality is quite different. I think it's important to set the stage. Having said that, these are going to be very, very difficult negotiations.
During your tenure, you were trying to, if I may, rehabilitate a relationship that had worsened during the first Trump administration. Develop conduits for communication, reestablish economic and security ties. When you left that post, could you have envisioned this turning out the way that it has, in terms of how the rhetoric has been ratcheted up, the tariffs that have been put in place? Is it the worst case that you envisioned, or worse yet still?
I certainly did not anticipate 145% American tariffs on China or 125% Chinese tariffs on American goods. And the trade war that has resulted effectively led to a trade embargo as of the past week, when no ships were sailing with goods back and forth, when manufacturers couldn't export to each other's countries, and you see the significant shortage of goods that traditionally are important to both economies. I didn't expect that to happen at all. And that's the most important thing happening in the global economy right now, which is another reason I think that eventually both sides have to agree to a deal to calm global markets. We're the two largest global economies, so we have a profound impact on the health of the global economy, but we also need the global economy to be functioning in a rational and stable way. There's so much at stake. I didn't see that happening. I think few people saw that happening. You remember candidate Trump pledged 60% tariffs on Chinese goods, and people thought that would be a revolution. Well, 145 was a revolution of a different magnitude. And I think, we're not anywhere close to being out of the woods.
Former U.S. Ambassador to China Nicholas Burns speaking to Bloomberg's David Gura. Meantime, Citadel founder Ken Griffin says holding cash would have been the best way to navigate the recent market volatility. He also told us exclusively that President Trump should focus on keeping inflation at bay.
Ultimately, any effort to force manufacturing back onshore into the United States is going to be inflationary. There's no doubt about it. And what frustrates me on this is that one of the reasons that Trump won the election was the American people had had enough inflation. They wanted a break from seeing their standard of living deteriorated by the ever-increasing price of goods and services. And so I really do think that the president needs to think long and hard about the necessity of helping to protect the standard of living of the American people by keeping the inflation, like, it's not a genie, it's like the inflation devil in the bottle.
So what does this mean for Fed Chair Powell? How difficult does this dynamic make his job, and do you think his job is secure through May of 2026? I
gotta tell you, I'm really happy not to have his job. Like, he is the biggest no-win job in the country, because through the lens of hindsight, we will always be able to second-guess every single decision he makes. Right here, right now, he's grappling with, do you cut rates as the labor market shows ever so slightly signs of softening, or do you hold the course because of the risk of an inflationary spike coming from tariff increases? He's going to have to make that decision based upon evolving policies over the weeks ahead. It's a really tough predicament he's in right here, right now.
Ken, it sounds like you have doubts that the American economy can be easily transitioned into a manufacturing one. What are the chances of making that work? And do you think that it's a realistic goal?
I mean, look, there's a great video clip from Dave Chappelle, and it goes something like, Americans want to wear Nikes, not make Nikes. And I think he's spot on. I don't understand why we think it's a virtue to bring back to America low-skilled jobs in manufacturing. I completely agree with the president. We need the ability to ramp up our manufacturing base to strengthen our national defense. Spot on right. But I don't think the American people are looking for a return to low-skill, low-paying manufacturing jobs in our country. I don't think they want those jobs. I think they want jobs where we are building high-value-added products, successful businesses building high-value-added products where you can create jobs in that factory floor that are well-paying jobs. Those are the jobs we should aspire to create in our country, not jobs that right now China is actually trying to move to other, even lower-cost labor countries. Why do we want those jobs here in America?
I'd love to see this from your position leading Citadel and also your message to Citadel Securities employees. What do you tell them to navigate all of this volatility?
So I will tell you that for my portfolio managers, it has been several really challenging weeks, because every couple of days there's another big headline on Bloomberg that we need to react to, and we need to reshape our portfolios with respect to. It's been a really difficult time for fundamental investors because so much of the value of the companies that we invest in is being dictated by very quickly changing policies from Washington.
So your best way to navigate that?
I think in retrospect, perhaps holding cash would have been the best way to navigate this, but that's so contrary to our culture of always trying to be on the offense, always trying to find ways to create value in the markets.
Is there something fundamental that's changing about the way you approach markets?
Look, I fundamentally believe that this period of instability that we're going through will come and go. Like, fundamentally, I believe that as the Trump administration moves through time, as policies become solidified, the economic backdrop against which one invests capital will become easier once again.
And that was Citadel founder Ken Griffin speaking with Sonali Basak for Bloomberg Originals' upcoming series Bullish. And even Ken Griffin himself got stumped. Here are some other stories we're following. Microsoft planning to axe about 6,000 jobs to reduce management layers. The company says the cuts amount to less than 3% of total headcount, including LinkedIn. About 2,000 workers will be impacted at Microsoft's headquarters in Washington, with terminations expected to start from mid-July. And hundreds of Starbucks workers have walked off the job since Sunday to protest a new dress code, with a union promising more strikes to come. Starbucks Workers United represents staff at about 570 of the 10,000 company-run U.S. stores. It's filed a complaint saying dress code changes during contract talks are unlawful. Starbucks says there's no significant impact to operations. And Disney has announced that its ESPN sports streaming platform will cost $30 a month. The product is set to launch later this year, offering access to live events, on-demand replays, and original programming. Disney will also offer ESPN as part of a bundle with Hulu and Disney Plus for $36 a month in a bid to attract more subscribers. And coming up, Martin Sorrell, founder and executive chairman at S4 Capital, will be joining us to discuss what he sees as the negative impact of Trump's tariffs on global business. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. President Trump and Saudi Crown Prince Mohammed bin Salman have touted a $1 trillion investment plan in the U.S., a staggering figure that doesn't quite stand up to scrutiny.
I like visiting with you, and we've known each other very well, and I really believe we like each other a lot.
But Today, we are working on partnership opportunities with $600 billion, including agreements worth more than $300 billion that were announced in this forum. In the coming months, we will work on second phase to finalize the remaining agreements to raise them to $1 trillion.
Well, for more, Bloomberg's Jumana Basechi joins us from Riyadh. Jumana, that $1 trillion pledge amid all the pomp and pageantry. Talk to us about what we're seeing, what we're hearing on the ground.
Yeah, well, I've got to say, I was in the room yesterday when both the Crown Prince and President Trump walked in together, delivering those remarks. It was quite an electric atmosphere. I think many of the Saudi officials and representatives in the room felt like Saudi Arabia was being presented on a global stage in a way that it has not been presented before. This was an opportunity really to showcase the country's transformation under Saudi 2030, and that is something that President Trump alluded to many times in his own speech, praising the Crown Prince quite lavishly. But of course, a lot of the focus into this trip was going to be around those deals. That big headline figure at the end of the day turned out to be $600 billion. But when the Crown Prince spoke, he talked about perhaps working on raising that number towards $1 trillion. In the Saudi Business U.S. Forum itself, $300 billion worth of deals were inked. Those include a massive defense deal. The White House are calling it the largest defense deal in history, with Saudi Arabia pledging to buy $142 billion worth of arms and weaponry from the United States. Partnerships in artificial intelligence. You've got the likes of NVIDIA and AMD looking to work with Humane, which is the Saudi Arabian AI investment fund, on powering and building up their data centers. We also heard about purchases of Boeing jets. 30 Boeing 737 MAX jets are going to be bought, in addition to further MOUs on energy and critical minerals as well. So a slew of announcements coming out of the forum yesterday, and both sides left feeling that Saudi Arabia, again, as I highlighted, was placed on the global map, and President Trump got to walk away saying he has got some of these deals, those lucrative commercial deals that he was looking for, over the line.
Talk to us about the AI deals in particular. I mean, Trump's Middle East visit, opening the floodgate for AI deals. You talked about NVIDIA, AMD coming at a time when the U.S. is trying to put a lid on exports of, AI chips to China.
Yeah, so there was a lot of talk yesterday about the Biden-era diffusion rules. And actually, David Sachs, who is the crypto and AI czar in the U.S., he was also at this Business U.S. Investment Forum and was talking in one of the panels about why those diffusion rules didn't make sense. They were too bureaucratic, and that there is a smarter way for the U.S. to control the dispersion of U.S. AI chip technology, but not do it in such a bureaucratic manner, and not do it in a way that the U.S. would lose its dominance globally in the technology space. So it seems as though there is going to be a reevaluation of those AI diffusion rules, and the U.S. are going to want to have more color on exactly what their partners in this part of the world are going to be doing with those chips. But from our reporting, from what we understand from the announcements yesterday, it does seem as though there will be some exemptions or exceptions even granted for those Gulf nations, and many of them, the likes of UAE, Qatar, and Saudi Arabia, all have massive AI ambitions, and a lot of that is contingent on getting access to those high-tech chips that President Trump seems to have granted them yesterday.
Jumana, thank you so much for that reporting. Bloomberg's Jumana Basechi. Japan back to trading. We're keeping an eye on Sony, by the way. Let's take a look at how Sony is doing. It is trading lower on the back of the outlook that it has given to us. The outlook underwhelming with U.S. tariffs waiting. Well, it's now changing direction, reversing its direction. Currently now up by about 0.1%, 0.7% as we speak, on news that it is buying back its shares. Of course, the company's quarterly results were buoyed by solid sales of its games, movies, and music. It's also come out to say that it is buying back up to 250 billion yen of its shares. That's lifting sentiment. Sony currently extending its gains to about 1.2% as we speak. And we will continue to track the shares as it continues to trade, coming back from lunch. Now, we're also counting down to the start of the tariff truce between the U.S. and China. Beijing says the 125% duties on U.S. goods will officially drop to 10% at noon this Wednesday. The combined 145% U.S. levies on most Chinese imports will also be reduced to 30%. The tariff reductions will give the two countries 3 months to work towards a broader agreement, with the possibility of extending the truce further if negotiations continue in good faith. Let's get insights on the trade war now with Martin Sorrell, founder and executive chairman of S4 Capital, whose business focuses on the digital advertising market. Good to have you with us.
Haslinda, yes.
It has been a while.
Yes.
Hey, so I'm wondering, what's your take on at least the suspension of the tariffs? That's good news, but that's temporary.
It is good news, and so is the stuff coming out of Saudi and the Middle East. I mean, there's one area of the world I think one feels a little bit more optimistic about possibilities of peace, and President Trump was talking about yesterday, would be the Middle East. I mean, US and China relations, maybe, over the weekend in Geneva we saw a change. My view in the long term, there'll still be, pulling against one another a bit, and of course when we have Russia as well. But the Iranian, Middle Eastern situation, maybe we'll see some progress there. So I think that's good news too. As far as tariffs, this postponement gives us a little bit of breathing room. But the simple fact is the world did change in the White House Rose Garden at that 9 p.m. that evening. We're not going to go back to where we were before. There still will be, in the case of the UK, a minimum of 10% tariffs. We're seeing 10% on the American side, 30% on the Chinese side. We'll have to see how the negotiation goes. But there was good mood music coming out. But I think longer term, there still will be a very competitive situation between the US and China. And I think that's something we all have to get our minds around. China will continue to develop. Very interesting, the stats in April. Chinese imports were actually up 8%. What it tells you is the Chinese pivot almost in a nanosecond, in an instant, to take account of what's happening. I mean, we were expecting Chinese exports to come under huge pressure. They didn't, because they flipped. Now, they may have been supplying Vietnam and Indonesia for re-export after, but the Americans obviously will be looking at that very closely. But basically good news. But the world has changed, and clients of ours are going to be looking at geographical expansion, I believe, in a much more fragmented and a much more careful way. And the parts of the world that will benefit are North America and South America, the Middle East, as we're seeing coming out of Saudi and UAE and Qatar, etc., and then finally Asia. Europe is on the back foot, and Africa, because of the number of conflicts, it's more micro than macro. So those parts of the world, plus technology, because I think the world will grow slower now because of tariffs. Inflation will be higher, despite what we saw out of the CPI in America. Not time for the tariffs to kick in. And then interest rates are probably going to be higher than we thought historically, and we thought we were going to be, because 10-year Treasury the yields went up in anticipation that recession, or the risk of recession, had been lowered. So in that world, technology and AI deployment and blockchain deployment and quantum deployment are going to become more important.
So how are your clients positioning? Are they holding back on investment decisions?
The level of uncertainty is huge, and corporations being corporations and being very short-term in their thinking, if you're a listed company, or even if you're private equity, where the average hold period is 5 years, you tend to take a short-term view. I think things are on hold at the moment, and people are being very uncertain about where they should go. Once the fog of tariffs has cleared, I was listening to what Ken Griffin was saying. I agree. I think once that 90 days, 120 days, whatever it is cleared, and we know precisely what the situation is, they will go full bore, in my view, in that lower growth environment to get tech in at scale. I think that's what you're going to see. So the AI adoption rate will accelerate markedly, and we'll see the sort of things that we're seeing at General Motors in our case and other companies will accelerate and even faster. The tinkering with audits and workshops and tests will go, and the pressure will be on to get growth growth in profitability and margin, and that will be done by deploying technology faster.
You're expressing optimism for the next couple of quarters then, right? But this is against a backdrop.
Well, I would say, let's say 90, 120 days until we see, as I say, the fog of tariffs clear. Once that's cleared, I think then companies will they'll be, it's like a dam building water. The water will burst through.
The fog of tariffs may clear a little, but it doesn't change the fact that tariffs will be implemented, even if it's 10%.
Well,
it
as
is
I said,
10% more.
The
so
world
I'm just
has
wondering,
changed. The world has changed.
What does that mean for your business?
Well, it means that we have to follow our clients, and I think geographically, as I've said, the pattern is going to be different. The Ted Levitt globalization era that started in the 1980s with Reagan and Thatcher, not gone completely, but certainly been de-escalated and lessened. And in the old days, in that golden era, where you planted your flag really didn't matter. As long as the demographics are with you, it worked. Consumers consuming everything in the same way everywhere. It's going to be different now. And as I said, there are going to be parts of the world that benefit. The Chinese, for example, are going to drive their exports away from America, I think. Whether there's an agreement on tariffs or not, they'll be focusing more on Europe, as they are already. We saw it in April. More on Asia, more on Latin America, and more on Africa. Actually, that pattern of trade has already changed. So the Global South, the BRICS, the next 11, which are 60 trillion. I mean, US is 28 trillion out of 106. China is 18, that's 46 out of 160. There's another 60 trillion that the Chinese play with. It's much more fragmented, but you've already seen it with Huawei. They were nixed in the US and the UK. They've gone elsewhere. Chery, one of the car manufacturers, also done. Now, it's much more difficult because the markets are smaller and it's much more fragmented, but the intensity of the effort will be huge. And one thing you know about the Chinese, they can literally turn on a sixpence. We're seeing it already in their pattern of exports, and it's quite remarkable how adaptable they are. Far more adaptable than Europe, for example, where I think things are going to be much more difficult.
But China is still finding it hard to boost consumption in the country.
Yeah, I mean, it's both the president and Scott Bessent are very articulate. Actually, Scott Bessent in particular, he's focusing obviously on tariffs. The next thing is tax, and they'll be lowering tax, and the third element is regulation. When you listen to him, it's very persuasive. The other thing that President Trump has done, whilst all this is going on, what is he doing? He's lowering the price of drugs, and of course. And the oil price, of course, has come down. And obviously, there's a lot of Saudi effort to lower the price, too. So there seems to be a deal having been done in relation to the oil price. Obviously, it reflects the risk of recession and the tariffs, et cetera, and levels of economic activity and that slower growth that I mentioned. But essentially, I don't think one should underestimate President Trump in terms of his thinking. And the key thing going forward to your question is what's going to happen in the midterms in America in 26. I mean, I hear a lot of Democratic noise that they're very confident that the House of Representatives will, that the Republicans will lose control of the House of Representatives and there'll be a deadlock. We'll see. I wouldn't underestimate President Trump. He's very astute politically. And what was really interesting, I was reading some polls this morning about the attitude of Trump voters, of Harris voters, and non-aligned voters. And on that drug issue, almost unanimity. In fact, Kamala Harris voters were more in favor of the drug price reduction than Trump voters. And what's very interesting, there's almost an alignment, the article was suggesting, between Trump and the Democrats on certain issues. You remember Trump has had lukewarm approval of taxing millionaires, which is, again, another Democrat platform.
So, Martin, I just want to pick up on the risk of recession.
Yeah.
I mean, some say in the U.S. Less now, but still, some say 30 to 50% in the U.S. Perhaps.
Yeah, I think.
How about Europe as well?
Well, I think Europe is the I was going to say dead duck. Maybe a bit, but UK is under huge pressure. Italy, Spain, France, huge pressure. Germany, more wiggle room because deficit spending is not a big issue. The fiscal headroom is greater. And of course, all countries are going to have to spend more on defence. And you have a Labour government, a left-wing or left of centre or centre-left government saying we're going to reduce welfare spending to increase more spending on defence because President Trump has withdrawn the safety blanket or security blanket. So it's a very fraught and difficult. These are developed economies that are in later stages of industrialization and not showing signs of growth and liveliness that we need. So I am quite bearish on Europe, and that's what I say. Those two things, geographical expansion, Europe is not as attractive, but cost reduction using technology, huge opportunities. Most clients that I speak to think of Europe as a cost opportunity, not a revenue opportunity. When they think of America or the Americas, when they think of the Middle East, when they think of Asia, it's a revenue opportunity. With Europe, they think about it in terms of cost. So technology, it's the second leg of what I'm talking about. Geographical expansion selectively, and then technological implementation at scale. AI to date has been done with tests and workshops. I was at a session of the World Federation of Advertisers here in Singapore just a few minutes ago, and one of the things, the messages was, really put your boots on in terms of AI deployment once the tariff fog is lifted.
So for Europe, what are the chances of that recession? Is it 80%?
Well, again, I think.
Can you put a number to it?
With the odds, J.P. Morgan, Goldman Sachs were raising to 50% probability of recession. I think in case of J.P. Morgan, even greater. I think it was 60, 65, if I remember rightly, before the tariff pullback. I mean, before President Trump and maybe the Chinese blinked. I think it was probably more President Trump and the bond vigilantes putting pressure on him. But whatever it is, it's certainly been reduced to lower than 50, maybe 30, 35%. But I think the US economy, it's very interesting what's happening. And maybe I'm swayed by the optimism that I heard in Riyadh yesterday with the launch of Humane and with NVIDIA and everything else. Those initiatives are very powerful. Positioning Saudi and the Middle East, it's not just peace conferences taking place there or conferences where people get together. It's about Saudi and the Middle East becoming a third force between the US and China, using Aramco's vast energy resources to power AI at huge scale. Really interesting what they're doing. We're from a communications point of view, involved in it tangentially, and I think really interesting opportunities.
How are you managing all the uncertainties? I know that in terms of headcount, for instance, you've cut that by about 8%. Are you done with that, or how are you looking at costs?
No, we have to. I mean, from a margin point of view, there's much more to do. So, I mean, our staff costs to revenue ratios are not where they should be. So there is more to do. But the technology is also changing the way we do things. For example, we've just produced 30-second TV commercials in 12 days for $200,000 as opposed to 2 months and costing millions of dollars. So AI at quality and at scale is doing things that literally 3 or 6 months ago were done at less quality or were not possible. So we call it the Will Smith spaghetti test. There are pictures of Will Smith on AI eating spaghetti, 2 or 3 years ago, and you see the improvement in quality. I mean, some of the advertising we're producing now using runway technology, which we've invested in as it's a $3 billion startup run by Cristobal in New York. And there's Minimax in China, which takes a similar approach, text to video, text to audio. These are techniques using Adobe as well, the Unreal Engine and other technologies, which are extremely sophisticated and are producing things much more quickly and much more cheaply. So the answer to your question is there will be a reduction in employment in certain parts. Personalization at scale, there'll be an increase. We can use assets at scale on individualized to, Haslinda's particular likes and dislikes for a Netflix or an Amazon Prime or whatever. at huge scale in a very different way to what we've done before.
So Martin, always a pleasure.
Thank you, Haslinda.
Thank you for joining us.
Nice to see you again.
Martin Sorrell, founder and executive chairman of S4 Capital. We're just doing a quick check on Tata Motors on the back of Jaguar Land Rover joining other car makers in withholding profit guidance, and that is due to uncertainty caused by tariffs. Tata Motors currently down by about 2.5%. We have JLR providing an update during the next month's Investor Day. Nykaa being added to MSCI Global Standard Index in the rebalancing. Keep it here with us. This is Bloomberg. A Morgan Stanley executive says the U.S.-China trade truce has set the scene for a rebound of U.S. stocks. Christina Au-Yeung also tells us she's seeing an imminent repositioning in China.
The conversation about U.S. exceptionalism and the challenge to U.S. exceptionalism has very often been associated with the Magnificent Seven. And the Magnificent Seven, as much as that leadership in the US has been driven by the large cap or mega cap stocks, it's not synonymous with US exceptionalism. US is still the deepest and highest quality market. There are many areas within the US to traffic that are very interesting. There is still significant innovation coming out of the US. And if anything, yes, we had experienced higher levels of valuations that were necessarily comfortable for clients to be getting into with fresh money. Now we've seen that retrace a little bit and actually setting a healthy scene to get back into some of these interesting names.
As it retraces though, and maybe some funds flow away from the US, where do they go into? What are you advising clients?
So on the other side of the US is actually what we've seen now in China. We're seeing an emergence of really interesting themes coming back out in China. We're seeing that China is emerging from being the world's factory, from making and manufacturing products for everybody else and servicing everybody else, to actually becoming a global leading innovator in its own right. And opening and paving the way for repositioning in China. Valuations are not demanding. We've seen significant investment in R&D, talent, capabilities, their own supply chain, and we're actually very interested in and excited about the opportunity set in China.
All right, before we go, here's a look at tomorrow's show. An exclusive interview with Piramal Pharma chairperson Nandini Piramal. We'll discuss the outlook for Indian drug makers as President Trump targets price cuts for Americans. Plus, we'll talk Mag 7 and U.S. tech stocks with Nia Impact's Kristen Hull. Well, that is it for Insight. Horizons Middle East and Africa is next. Do keep it here with us. This is Bloomberg.